Good afternoon, and welcome to the first webinar organized by the Capital Market Development Committee of FINEX, which is ably led by the dynamic duo of Zondi Garcia, the Liaison Director, and Tess Ravolo, the Chair of the committee. I'm Malu Cristobal, and I'm the Vice Chair of the Capital Market Development Committee. We are facing what may well be the worst global recession that could rival the Great Depression in the late 1920s and the early 1930s. And the conventional wisdom is where business and the economy go, so goes the capital markets. And this is precisely the reason why we put this webinar together, to be able to take a long, hard look at the capital markets in the time of COVID-19. Let me start by asking all of us to pause for a short prayer. Almighty Father, in the midst of this crisis, we pray for healing of family, friends, and colleagues afflicted with the virus. We pray for eternal life for those who have succumbed to it. We pray for strength and protection for the frontliners who put themselves at risk to keep us safe. We pray for wisdom and guidance for decision makers in government and private businesses. We pray for kindness and generosity toward the dispossessed and marginalized. We pray for faith to conquer our fears, hope to see beyond this crisis, and love to care for and nurture all of God's creation. Amen. Let us now put our right hand over our heart and join in the singing of the national anthem. Let me now call on the FINEX President, Jeng Pascual, for his welcome remarks. Jeng.
Thank you very much, Malu. Welcome. Good afternoon to our FINEX members and guests, especially to our distinguished speakers, the Honorable SEC Commissioner Efiro Luis Amatong, Mr. Mike Ferrer, Managing Director of ATR Asset Management, and Mr. Toti Bengson, CFO of Ayala Land, and our current, or 2019, ING FINEX CFO of the Year. Welcome everyone to our Capital Markets in the Time of COVID webinar, sponsored, as mentioned by Malu earlier, by the FINEX Capital Markets Development Committee. For those who recall me saying in previous sessions like this, there are three things the business community needs to think about in relation to COVID, and I call this the 3 R's: response, resilience, and recovery. For those who have been with us in our past webinars, the focus was more on response and resilience in light of the COVID pandemic. Whether it was about liquidity and cash management, HR, labor issues, MSME challenges, even water security, and digital transactions and payments. Now we start to look at recovery. in particular, how government is managing the impact on capital markets, and in particular supporting the corporate sector. It's also about how capital markets have reacted and where the opportunities lie, and how our leading corporates are thinking about bouncing back from the crisis. I must say this is a record-breaking webinar because we have breached the limit of maximum participants or people who registered. So I think more will be coming in, trickling in as we progress this session, which I think gives a sense of how everyone finds the topic on capital markets important. So what I'd like to do now is just welcome you to this webinar. I encourage you to ask questions and keenly listen to our distinguished speakers who have a lot to say about what I just mentioned as the key topics. So I'd like now hand over to Malu to introduce them properly. Thank you.
This afternoon, three very prominent personalities who have played very significant roles and have made valuable contributions to the development of the capital markets as investor, as issuer, and as regulator. In the interest of time, and because they are very well known to all of you, we are dispensing with a lengthy introduction of our speakers. What we will do instead is we will append their very impressive CVs to the presentation materials, which I hope will be circulated to you after this webinar. Our first speaker is Michael Ferrer. He's Chief Executive Officer of the ATR Asset Management Group, otherwise known as ATRAM. And Mike is a 30-year veteran in banking, asset management, and private equity. Our second speaker is Augusto Bengzon, Senior Vice President, Chief Finance Officer, and Treasurer of Ayala Land, Inc. Torti sits as director in 2 publicly listed and about 30 privately owned companies under the Ayala umbrella. As was mentioned earlier by Jeng, Torti also holds the distinction of being the ING FINEX CFO of the Year for 2019. Our third and anchor speaker is Honorable Efiro Luis Amatong, Commissioner of the Securities and Exchange Commission, responsible for the Markets and Securities Regulation Department and the Economic Research and Training Departments. ComF is an old hand in government, having served at various times and in various capacities, the National Park Corporation, the Local Water Utilities Administration, and the Department of Finance, among others. Before I call in Mike as our first speaker, let me just call your attention to the Q&A button below your screen. If you have any questions you wish me to ask later on, just please type your questions in that and click that particular button. With that, let me now call on Mike Ferrer for his presentation. Mike?
Hi, good afternoon, everyone. Can you hear me?
You're coming in well.
Okay, just loading up my slides there. I hope you can see them. Well, first, thank you all for inviting me to be part of this webinar. And I've been asked to talk about 2 things really. First is investor behavior in the current environment, in the current crisis, especially in relations to capital markets, and a little bit on what the industry is doing for the capital markets, both in the short term and in the longer term as well. So I'll focus on that. This won't be quite a market outlook per se. We do that every week, by the way, every Thursday, and certainly you can catch that in Facebook, or we're happy to invite you as well to attend that. So, just to start off, Jeng mentioned the 3 R's of FINEX, and what I'd like to say at the outset is that topmost in investor minds today are 3 things, which I call the 3 V's. The first is the virus itself, and the key question is, when will this pandemic end, and when can we get back to normal, or the new normal? The second V is valuations. Have markets priced in all the economic and financial damage that this pandemic has caused? And third is volatility, which for fund managers like us is our language for risk. No? So our goal is always to manage risk. And you know, the key question is when will sentiment change, and when will investors be willing to take more risk again? So this crisis, while we're still in the middle of it, has already been compared to other crises. Malu mentioned recession. I think more closely we compare it to the '08 crisis and perhaps the Asian crisis in '97. But each crisis is unique, and I think the unique thing about this crisis is speed. The speed of the spread of the virus, number one. The speed of market corrections actually is also the fastest we've seen in any crisis, and investors haven't been able to react to this in certain cases. But third, against that is the speed also of the government and central bank responses to the crisis in an effort to stabilize markets and ensure that liquidity flows. So the interplay of these forces has really caused markets to move the way they have. And in this chart, I'm just showing here, you can see that risk assets have been sold off, equities primarily, but also commodities with a drop in demand. And in the fixed income space, certainly the high yield side of the market, emerging market debt, for example, has been sold off. But you see there positive returns in Philippine fixed income and global fixed income, mainly US Treasuries and Philippine government bonds, as a result partly of and mainly of the actions of the central banks, the quick action of the central banks in the middle of the crisis. And interesting also, I think, is since the middle of March, which is when most of the lockdowns in the world happened, markets have actually recovered somewhat, you know, partly again as a result of the stabilization efforts. Not to say that we've seen the bottom, but certainly the fast action has helped a lot in you know, stabilizing markets. Now, the Philippines, as you saw in the previous charts, has been a laggard, the Philippine stock market. And you'll recall that in January, we already got hit by the Taal volcanic eruption, which in itself was a disruption on business and economic activity. And, you know, as we were reeling for that, the virus hit and the lockdown happened and markets corrected further. So we're about 27% down year to date, and we've been trading lower than the end of the year level. So the question really in most investors' mind is that, is there value in the markets today? And you'll see in these charts, we look at historical valuations to try to get a sense of value in the markets today. And certainly on the left chart, you'll see the PE levels or bands that the market typically trades at least for the last 5 years. We've traded at between 16 to 21 times, reflecting, of course, all the earnings momentum and growth that we're seeing in corporate earnings. And with this crisis, we're now trading below that. Of course, the caveat there is earnings this year, in these charts, the earnings that are being shown here are the pre-crisis and lockdown earnings forecasts of analysts. And of course, we have to throw that all out of the window today, you know, and analysts are still working on the new forecast for the year. But, you know, PE aside, I think another metric that one could look at is the market cap to GDP ratio, and by that, which is a stabler measure, by the way, the Philippine market indeed looks very, very good value at the current levels. The bond market has been the safe haven for investors. Clearly, from the start of the year, we've seen lots of interest, and there was a bit of a sell-off in March. But as soon as the BSP moved, and they moved very quickly by cutting reserve requirements, um, cutting the policy rates, and doing its own version of quantitative easing, certainly that this is something that we learned from the '08 crisis, and the speed with which the BSP came forward really caused the bond markets to rally. So as you can see there in the yellow line, these are where yields are as of month end, very much lower than they were, the start of the year. And investors, if you had invested in a government bond portfolio since the start of the year, you would have been up 6 or 7%, which is a pretty good return in any year for bonds. Um, Despite all the government actions and the central bank moves, however, from a risk standpoint, I think investors are very much wary about how things will pan out. And that's reflected in the volatility index, or the VIX, as we call it, which is your greed and fear index, if you will. And the levels today still show that there's a lot of fear built into investors' minds today. And what does not help, obviously, is movements in certain markets, like the commodities market, where we saw oil futures trade as low as minus 37. It lasted a very short period of time. And of course, there were technical factors for that. But that kind of volatility really spooks investors and makes investors want to lower their risks in the portfolio. And the move of gold also shows that the risk aversion of investors in the current environment. So I think in this whole crisis, and it is a global crisis, of course, the Philippines stands out really as the economy that is really poised to recover and recover quickly. We're not saying it's going to be a V-shaped recovery. At the moment, I think there are just too many variables to forecast. But certainly from a balance sheet perspective, Philippines has one of the lowest debt to GDPs and has a lot of room for fiscal stimulus. And we're hearing already about the package that's in Congress to really help spur the economy. And the graph on the right compares what might be a scenario of recovery for the Philippines. I'm not sure if you look at that as a U or a V-shaped, but clearly there will be some pain. There will be probably 2 quarters of negative growth. Don't know how deep that will be, but we are expecting, but by the 4th quarter, assuming there's no second wave and another lockdown, we might be close to, if not at, the pre-lockdown levels. And that will set the stage for a strong recovery next year for the Philippines. No? And I think the proof of investors' positive view on the Philippines has really been our government bond issuance, our dollar bond ROPs that were issued in the middle of the crisis. We raised, government raised about 2.3 billion. The book was oversubscribed. The yield was very low. And in the secondary market, the spread has tightened. So I think really for the Philippines, it's not a question of if, but when the recovery will happen. So I think investors today, we like to think in terms of cycles, business cycles, and that's just a graphical representation of the normal business cycles that we look at, and which asset classes tend to perform well. And clearly we were already entering a period of a slowdown in growth, at least globally, maybe not for the Philippines as much. But what the crisis has done was put the global economy on a standstill. So this whole clock or cycle has to be reset. And the speed with which we will move from a reflationary and a recovery environment is still the big unknown at this point in time. And so that has really driven investors to go for the very short-term, high quality and very liquid types of investments like deposits, government bonds, and potentially corporates with very, very strong balance sheets. For now, I think the illiquid asset classes, private equity and even the high yield sector, where there might be questions of credit, will be, I think, very far from investors' appetite today. No? And I think that has implications now to the corporate bond market. So I think if there's anything that can really become or evolve into the crisis is if flows into the credit market stop, no? If there's a freezing of credit flows. And I think that's what we're all trying to avoid here. There's been a lot of attention in the SME sector, and the government has been quick in trying to address the issues there, particularly protecting the labor side of things. But a big problem can evolve if corporates are not able to refinance and roll over, and actually even potentially borrow more to restart their businesses. No? And the issue with the corporate bond market, it's about 1.5 trillion, I think, today, if you include bank deposits, is that it's a very illiquid market. And that is problematic for fund managers like us who manage mutual funds or unit trusts, which are open-ended. So we have inflows and outflows into these funds. So there's a limit to how much we can buy of these corporate bonds, simply because if we have a redemption, we'll have to fund that by selling assets. And I don't know if you saw in India, one of the major fund houses had to close down certain funds because of illiquidity of underlying corporate bonds. I don't think we're in that situation. In fact, anecdotally, we have not seen a lot of redemptions in funds. But the question really is whether these funds and these investors can and are willing to take risks on a 5-year or 7-year corporate exposure at this point in time. Not to say that we don't believe in the credit. Certainly, we would love to have this credit, but it's the liquidity of being able to get in and out of these bonds. So we've actually proposed to the SEC, and we can discuss it a bit more in the Q&A, new fund structures, basically closed-end bond funds that can really match investors with credit portfolios and really fund the 3 to 5, 7-year requirements of corporates. No? So I think that's key in the short term, but as the fund management industry has put forward its proposal for long-term capital market development, because we will face another crisis after this. And the key for long-term capital market development really is having the demand side and a pool of long-term funds to really be able to match the credit requirements or the borrowing requirements and the long-term borrowing requirements of both corporate and government. If you think infrastructure bonds and other types of really long-term bonds, you really need to have a pool of assets there. And in any market you look at globally, pension funds are the ones that actually fund these long-term credit requirements of companies and governments. And today, the pension asset level of the Philippines is quite low. It's at 16%. That includes already your government pensions like GSIs and SSS, as well as the private sector pension funds of corporations and the new PERA. That level needs to go up in order to have a big pool of funds that can really get the corporate market to thrive further. No? And we've put forward a proposal to reform the pension system, addressing the portability issues, the funding issues, and hopefully it gets into the 5-year capital market development plan of CMDC And with that, I think we'll be much more ready to face any crisis in the future. And just as an example is the Chilean pension system, which virtually started with nothing 40 years ago, but over that period of time has raised pension assets significantly, which has raised savings rates, increased investments, and broadened and deepened both the equity and bond markets. So I just like to end where this whole crisis began, which is the virus. It's still about the virus at the end of the day. And we know that the lockdown is not really the solution, and we can't keep the lockdown forever. So unless and until a vaccine is discovered, you know, the confidence of people to spend and to go back to their old way of doing things is probably going to be limited. But I think what's encouraging and what makes me optimistic is also the speed and the amount of resources that have been put to bear to find that one solution we need, the vaccine or some sort of a cure for this virus. And believe me, once that vaccine is identified, the market sentiment can change very quickly. And if you're one of the investors or you're the investor who was sitting on a lot of cash before the crisis happened, you would have avoided a lot of the pain. But I think equally important is at the tail end of this crisis, you need to put that cash to work. Otherwise, it would have been a big opportunity wasted. So I'd just like to end there and look forward to the Q&A. Thank you.
Thank you, Mike. Can I now call on Toti Bengson to make his presentation? Toti? Toti, you're on.
It's now day 51 since the ECQ commenced. And what I'd like to do this afternoon is to share with all of you the 5-point action plan that Ayala incepted at the start of the ECQ period. So I remember the day clearly, March 16, we all went home with our laptops in hand. And March 17 was the start of the ECQ. And we hit the ground running. 8:30 in the morning, the Ayala Land Mancom gathered, not in front of Zoom. We used Microsoft Teams. And that morning, our CEO walked us through our 5-point action plan to help us get through the COVID-19 pandemic. Next slide, please. So in broad strokes, this is the 5-point action plan. First and foremost, of course, was to ensure financial sustainability for the company. And by financial sustainability, what we meant was really to ensure that we had more than enough liquidity to weather the storm, no matter how long the storm would take. I've also put it at the bottom of this chart. It looks like a house because these financial sustainability initiatives provided us with a platform with which to do the things that we thought were most important to execute during this pandemic. You see it there on the left-hand side, protecting our employees, serving our customers, helping the community at large. And that early as in March 17, we were already thinking, this too will pass, so how do we recover and move forward? I've also put it financial sustainability at the bottom because I'll start with our liquidity initiatives, but I'll also end with some thoughts on our financial sustainability plan. So it was all about liquidity. And in the early days, I would say the first 2 weeks, things were really a little bit stressful. And I can confess I did lose 4 pounds because things were so uncertain. So that was the good side. But having said that, we knew liquidity was key. And so we took quite a number of steps to ensure that we had more than sufficient liquidity. First on the list was to ensure that we were squaring our operating cash flows. We knew that some of our businesses were impacted. The malls were not fully open. Hotels clearly were going to close. We expected some slowdown in residential sales, but we still had cash flows coming in. So in terms of our mall portfolio, the drugstores, the supermarkets, the groceries remained open. So we estimated that about 12% of our total leasable area was operating. For our hotels, we were quite fortunate that we have 11 hotels that are still open. And they've been primarily taken over by BPOs who were requested for shelter for their employees. So today, our hotels have close to 55% occupancy. Residential, we continue to make good on our collections. Resorts definitely were all closed. But long story short, revenues continued to come in. What we needed to quickly get a handle on were our operating expenses. So immediately, we turned off and optimized our operating expenses. In addition to that, we reduced our capex. Immediately, we saw that things are going to be slowing down for a bit. So our capex, we can afford to reduce. So from a budgeted capex of 110 billion pesos, we dialed this down to 70 billion pesos. And when we matched that with our net operating cash flows, we were comfortable that we would have more than enough liquidity to get us through this storm for however long it would take. And part and parcel of our liquidity exercise was to strengthen our balance sheet. So even as our cash flows had been reduced, but by virtue of our cutting down on our expenses and trimming our capex, we still had enough, or we still have enough, we think, to give us an ability to potentially pay down debt towards the latter part of the year. And in the process, further strengthen our balance sheet and give us the necessary gunpowder when things turn around and when we want to get into our aggressive mode once again. On the right-hand side, I just wanted to show you, these are the NAV calculations of Ayala today. These are calculations from the big brokerages, and these are all calculations post-COVID. So they've dialed down their calculations of ALI, but as you can see, our NAVs remain quite high. Our share price today is trading at a discount to our NAV, which is something to be expected given the uncertainty. But we are confident that as things turn around, we should be able to see a recovery in our share price. And more importantly, with the actions that we're taking, we want to make sure that we preserve the value of the company. So even in this crisis, we are not going to make any rash decisions. There will be no fire sales. From the liquidity exercise that we had undertaken earlier on, we believe we're in a good spot and we should be able to ride out the storm and come out stronger. Next slide, please. So what were the things that were important to Ayala Land? As I mentioned, number one, protecting our employees. So on day one, March 17, everybody was ready. They were all working from home. We had already rolled out Microsoft Teams in the previous year. So everybody had been familiar with that platform. And today I can say that 85% of all our employees, of our 6,000 employees, are productively working from home, primarily made possible by the provision of laptops, pocket Wi-Fis, everybody working on MS Teams and collaborating on OneDrive. Every day we take stock of the health of our employees. So we do have a regular monitoring of employee health by SBU. And today, fortunately, we only have 3 COVID positive employees. And hopefully, all of them will recover. We've already seen one recovery. In addition, we retrofitted our New Valley Visitor Center, converting it into a temporary medical facility for Ayala Group employees in the event that they experienced COVID-like symptoms. That's being operated by ACL. We've also provided a multitude of employee care hotlines through which our employees can dial in and seek support, be it for medical or even psychological issues. And finally, recognizing that some of our employees may have needs during these difficult times, we distributed the 14th month pay. Next slide, please. Equally important was to continue serving our customers. So I'll just briefly run through how our various SBUs are serving their customers. Today, 19 of our estates continue to operate and are properly covered and manned by the respective personnel. Our residential properties, most of them managed by APMC, have on-site workforces. I'm quite proud of what our APMC has done, wherein quite a number of our property managers have lived on-site in their respective residential developments to ensure that there would be no contamination. Effectively, they've decided to self-quarantine in their place of work. And within those properties, a COVID-19 crisis committee has been established, headed by the board and the homeowner association officers. I mentioned previously that in our malls, about 12% of our total GLA, or gross leasable area, continues to operate. You may have already tried going to a supermarket located in our malls. We provide free parking, and customer service continues via online channels. You may also have read that we already condoned 2.6 billion pesos of rent from those merchants who were affected by the shutdown. And the appropriate site assistance and equipment monitoring, together with property maintenance and mall security, continues in all our malls. Ayala Land offices, all our offices are operating. BPO headquarter buildings, including data centers, are open. And hotels, as I mentioned, have been utilized by quite a number of BPOs to shelter their employees. We have 9 said hotels and 2 branded hotels that are open, supported by some 430 hotel staff. Our resorts are closed, so the employees of our resorts are working from home and are providing skeletal force services to the resorts. In the meantime, requests for rebooking and refunds for our resorts have been processed promptly without cancellation charges. Next slide. Similarly, for AirSwift, our airline, all cancellation and rebooking fees have been waived. APMC, our property management company, has deployed close to 7,000 building personnel and are working on-site across residences, buildings, and estates. At the same time, they make sure that all their personnel are fully supported with safety and PPEs and are provided the necessary assistance, lodging, food, transportation, and in some cases, financial aid. MDCA, our construction company, as you know, construction activities have ceased. So they remain in close coordination with our business units on the construction activity programs, and they're now preparing reopening protocols. Once the ECQ is lifted, then we expect to go on GCQ, and we should have a gradual deployment of construction workers to our project sites. Our industrial parks and warehouses, primarily under our other listed company, Ayala Land Logistics Holdings Corporation, that's all operating. Our manpower of 350 service providers ensure safety and cleanliness of the properties. Next slide. We have 2 in-house BPOs. Amicasa is our captive BPO that provides documentation services for our residential buyers. So 82% of the workforce is working from home, and you can see the stats there. They continue to process all our bookings and continue to work on the release of titles. Aprisa is our in-house, if you may call it, our in-house payables processing BPO. So 92% of that workforce continues to service the company, and they continue to process close to 1,100 requests for payments on a daily basis. And for those who have purchased our residences or are in the process of purchasing our residences, our residential customer relations team continues to be in touch with our customers and constantly address a multitude of inquiries, requests, and concerns. Helping the community was something we moved on quickly. I believe Mike talked about how quickly government and the BSP moved to address this crisis. And I'm quite proud about what the private sector did, because in the early days we recognized that all those under quarantine would have no access, would be on no work, no pay, and would potentially have no source of livelihood to pay for food. So immediately, Ayala Land, together with the private sector, mobilized. In the case of Ali, we allocated 600 million pesos as financial assistance for about 70,000 of our non-organic employees. Discover our construction workers, maintenance staff, messengers. So that that allowance, we believe, would be good for at least a month and a half, just until the time that the government would be able to release its social amelioration funds. In addition, as we released our 14th month pay, we also went to our employees and asked them to donate. And I'm very proud of the response that we got from our Ayala Land employees. 99.9% of all employees contributed to a fund, raising 82.6 million pesos, which we then deployed to the three main COVID hospitals, PGH, the Lung Center, and this Dr. Jose Rodriguez Memorial Hospital, and Caritas Manila. You may also have read that the Ayala Group, together with a whole host of conglomerates, spearheaded Project Ugnayan. Ali by itself, together with our business partners, raised a total of close to 500 million in donations, which we then turned over to Project Ugnayan for Caritas Manila. Our MDC was instrumental in transforming the World Trade Center into a 500-bed quarantine facility, and we retrofitted the Philippine Red Cross lobby into a COVID-19 testing lab capable of processing 3,000 tests per day. Qualimed, in partnership with AC Health, expanded their hospital in New Valley. Our Qualimed New Valley is a COVID hospital, and it has dedicated facilities to handle all those that have been infected by COVID. And our AirSwift, together with the DOT and foreign embassies, made 78 domestic flights available to allow 4,500 tourists all over the country to catch their flights back to their home destinations. So today, we are now thinking about May 16 onwards, and these protocols for re-entry into the workplace are still being discussed. One thing for sure is that most of us will continue to work from home, given that we've shown that we are quite productive on a work from home basis. As you can see on the right-hand side, we ran a survey and it was responded to by over 2,000 of our employees. And I would say about 93% are relatively productive under the work from home arrangement. However, we do know that there are some concerns, primary of which is the connectivity. Internet connectivity is a concern for 50% of the respondents. That is something that we can address to ensure that on a work from home basis, our employees continue to be maximum or will have maximum productivity. At this stage, we're thinking that high-risk employees, 50 years and above, so that includes me, will continue to work from home, which is something we've been doing and we've gotten quite comfortable. The senior management team continues to meet on a daily basis through Microsoft Teams, and we in turn are able to meet with our respective groups, again, almost on a daily basis through video conference facilities. Microsoft Teams has proven to be an invaluable tool during this time. Antibody testing, still something we're discussing in great detail. There's several opinions. We will still have to figure out who and what kind of testing we will undertake. But certainly safety measures will be implemented in the workplace. Will be implemented in the workplace. Social distancing, temperature checks, regular sanitation of the premises, centralized receiving of meals and packages. This will be the new normal. So I'll go back to the finance part. And this was something I presented to the senior leaders of the company on April 3. So 2 weeks after we had gone on lockdown, we called the management team to a meeting. And I said, I can only guess what the future holds. But perhaps this is my best estimate of the timing and the periods that we will be going through. First, from March to May, I termed it the survive phase, which is a bit of an overstatement because as I had mentioned, we were fairly confident of liquidity. But after that, we would move on to a stabilization phase before we start thriving once again. And under survive, the critical action plan was on tighter cash flow management. So I'm sorry, I've had to redact certain items there for confidentiality purposes. But I think you'll see the general idea here. Tight cash flow. Liquidity is key. Cash is king in the early days. So let's make sure that we generate net cash flow from operations, which would be sufficient or close to sufficient to covering our capex, as well as ensuring that we would be able to service our interest expense. So together with the tight cash flow management, we're starting on something that we've never really done formally, but now we're going zero-based budgeting. Every line item, every cost is now being scrutinized. Cost of sales, direct operating expenses, general administrative expenses. All of those we will look through with a fine-tooth comb, and assumptions in the past will not hold. If the assumption in the past was this cost will grow at the same pace as inflation, that's no longer acceptable. We need to look at what activities are these costs supporting, and we need to justify each and every centavo now. Digitalization. Previous slide, please. Digitalization is a journey that we've been on for many years. I would say in 2017, we had already been on our digitalization strategy in earnest. We've moved to the cloud. I think automation is something that's been at the heart of all our process enhancement initiatives. But with this crisis, I saw the opportunity to fast track certain digital initiatives that had been sidelined. So the joke that we have with the CEO is who drove digitalization? A, was it the CEO? B, was it the CFO? C, was it the CIO? And the answer was none of the above. It's COVID. So with this crisis, it only brings to fore how critical it is for the company to digitalize. We've gone to great lengths to digitalize our business, but we're going to take it a step further. So as you can see, there's some key initiatives we'll do, phase 1 up until the end of this month, and we'll move that to phase 2 in 2021. Turning to the stabilization phase, which is where we're at today, DCM refers to the debt capital markets transaction that we have launched. Some of you may be aware, we're working with 3 of our underwriters to launch a 2-year bond. We hope to submit our offer supplement by Friday to the SEC, leading towards a listing sometime in June. Of course, you know, we want to also list a REIT. So we're in touch with both the PSC and the SEC on a couple of items, and hopefully, market conditions willing, we'll see the REIT in sometime in the 3rd or 4th quarter of the year. Now, once we have these things in place, going into 2021, we can start growing our launches or initiating our launches and growing our capex once again. So all of these, the growth that we want to get back on track on, is going to be in no small measure dependent on the capital markets transactions that we hope to complete. Next slide. So I just wanted to show this slide of Ayala Land's history over the past 30 years, the past 3 decades. We're now on our 32nd year as a company, and if you can see, in the first decade, we grew our net income by 14%, while GDP growth over that period was at 3%. In the next decade, we grew our NIAT by 4%, while GDP was growing at about 4% as well. And in 2009, we just took off. Our net income grew by 23% on a compounded annual basis, while GDP equally was very strong at 6%. In all cases, you can see that the share price of ALI grew faster than the stock exchange index. Now, why am I showing this? Because the question is going to be asked, what kind of recovery do we see? And the answer is, frankly, I don't know. Is it going to be a V, a W, an I, or an L? I guess I just can look back through history, and I look at the period 97 to 2000. 97 was when we had the Asian financial crisis. You can see in the chart there, our net income came down by 40% by 1998, and over the next 2 years dwindled even further. All told, in that 4-year period, our net income was down 60%. And then the next period where we experienced a downturn was in 2008, during the global financial crisis. We were down 17% by 2009. So relatively short-lived, because 2009 onwards, we just took off in line with the growth that the economy was also experiencing. So going forward, 2020, 2021, 2022, I don't think you can expect our NIAT to be growing higher. Most likely, you will see a correction, or most certainly, you will see a correction. But with the capital markets, with the support of our employees, with the support of our stakeholders, we hope, and at some point, we will get back on a growth track. So just a few messages. The theme of this discussion was capital markets in the time of COVID-19. And these are my 3 thoughts. Number 1, the capital markets has been essential in providing liquidity and allocating capital. We listed our first bond in 2008, and 2009 onwards, the company just grew by leaps and bounds. And I can attribute that to the support provided by the capital markets. Clearly, our ability to access the capital markets has been an invaluable source of support. So we've always believed it's good to have 2 wheels running. We have our bank funding in place, but we also need to have the capital markets ready to support us. And we've seen that today. I think the banks are probably more constrained with lending to even large corporates like us. from a pricing standpoint. And what I mean by that is, although benchmark rates have compressed, we feel that credit spreads coming from the banks are still relatively elevated. And I believe that's because the bank has to look at its overall portfolio and needs to price accordingly. Unlike the capital markets, when they see Ayala Land coming to the market, then they price our credit risk, I would say, more appropriately, and they look at the risk just of Ayala Land. So our ability to launch this 2-year bond in the next couple of days is going to be quite crucial, and it will demonstrate, point 2, if you're able to operate with the capital markets fully functioning, then it's a seal of good health, because in our case, the ratings agencies would have looked at our offering supplement. The regulators, the SEC, the PIDEX will look at our documents. Our underwriters will evaluate our risk, and ultimately, the investors who come to the table will determine, is Ayala Land a good credit, and will it provide a good risk-return equation. So with the capital markets fully functioning during these times, it sends a message of confidence to everyone. And my final thought is, bayanihan is what's happening. We've got our issuers, investors, our financial institutions, regulators, ratings agencies, lawyers and accountants, and all our other stakeholders coming together to kickstart the capital markets, even as we're facing what could be the greatest challenge of our time. And once we get the capital markets moving, then I think we'll have a clearer picture of how we will operate under this new normal. So with that, thank you very much for this opportunity to share our thoughts, and look forward to your questions later on this afternoon.
Thank you very much, Toti. We certainly have a lot of questions for you, as well as for Mike, and obviously for ComF later on. So let me now call on Commissioner Efiro Luis Amatong for his presentation. ComF.
Thank you very much, Malu. Let me just get my presentation up and running. So, yeah. So thank you again to Malu and to the organizers, to FINEX, for giving us this opportunity to speak to you and to participate in this webinar on capital markets in these very unusual times that we're facing. So let me just go very quickly through our standard disclaimer for purposes of this webinar. The views that I'm going to express and are contained in my presentation are my own and do not necessarily represent those of the Commission, the commissioners, or the other staff members. And this is an important disclaimer because it allows me to be more candid with you, particularly during the Q&A. So with that done, let's go to what we all know already. The COVID-19 pandemic has created tremendous economic pressure worldwide, and we are all expecting a downturn in our economies and recessions in the near term. And this is largely due to some of the factors that Mike mentioned: the speed at which the virus has spread worldwide, and also the way that the virus itself, as well as the response to the virus, has resulted in measures that dampen economic activity. In effect, all our businesses are affected by the COVID-19 pandemic and make it difficult for business to take place. And another factor that is unique to this external shock is the uncertainty surrounding the length of time that we will be under this kind of condition. So Mike noted that the virus spread very quickly throughout the world, but we are all uncertain as to how long it will take before we can return to the old normal, away from the new normal. How long will it take for either an effective treatment to be developed, or a vaccine or for the virus to run its course throughout the population. And in reality, no one knows. So these are some estimates, baseline assumptions provided by Moody's, which seem to have the virus petering out in the base case towards the middle of the year or towards the start of the third quarter. But in some other estimates, you have estimates of this situation persisting for a much longer period, maybe a year, maybe 2 years, before there is an effective treatment or vaccine to the virus. So we don't know how long it will take, but the basic assumption that I think everyone has is that there is a definite period for this health crisis, that it does have some kind of endpoint in sight. And the other thing is it affects both the health crisis and the response to the health crisis affects different industries differently. Some are more, are impacted to a greater extent by the virus and by the response to the virus, which has largely been use of quarantine and social distancing. Some are less affected, and then in theory, things like online transactions actually get the boost. So if you remember, Toti just mentioned that the biggest driver, at least for Ayala Land, for their digitization process is not actually top management but this COVID-19 pandemic. So if you also take a look at this, you'll notice that ALI's lines of businesses run the whole gamut from low exposure with food through their supermarkets to moderate exposure and to high exposure. But at least for Ali, they're just developing a response to these impacts on their companies. And even the rating agencies, Moody's and S&P, would say that not only does the crisis impact different industries differently, even within the industries, there can be differentiation on level of impact on the companies involved. Now, turning closer to home, Philippines is not a stranger to crises, and economic or otherwise. And we're known for our resilience. And one way I think we can think about resilience and ultimately recovery from this pandemic is to compare this pandemic in a way, to an external environmental disaster or pressure. I'm not the first to suggest this. There have been some economists who have suggested you think of it like some kind of natural disaster, which in a way it is. But if I were to compare it to a natural disaster, I'd like to think of it as a slow-moving typhoon. Slow-moving typhoon, because you can see it. It arrived here quickly, but you can see it move slowly through our economy. And we have some ability to adjust to it as it moves through. And in fact, we have adjusted in some way. So I personally like to think of the COVID crisis as a sustained long-term typhoon-like impact that prevents people from going to work, people from going to school, engaging in economic activity, and otherwise participating in the economy for a very long period of time. The other thing to note is that unlike even a typhoon, this external shock does not destroy physical assets. It's a serious threat to our health and the lives of our people, and particularly the frontliners who are at risk and are holding this virus at bay. But it doesn't result in the kind of property damage that a typhoon would. Now, the other way I try to think about this crisis is the IMF has a kind of four-quadrant tool to thinking about financial crisis, where the economy is viewed in essentially four quadrants: government, banks and financial institutions, households, and corporates, and the way shocks, systemic shocks, impact the four. Now, I know, like you know, that these four quadrants actually interact with each other, and we'll see that in a bit, but I think it's also a useful tool to think about how the virus and how the pandemic and the quarantine resulting from the virus impacts our economy across these four sectors. Because the interesting thing about this crisis as compared, and I think both Toti and Mike compared this crisis to the 97 Asian financial crisis and the 2008 subprime mortgage crisis. But significantly, I think the Philippines can argue that this time is a little bit different, if not significantly different for us than in previous crises. And the most obvious thing to point out really is that our fiscal position of the government is much stronger than it was, even as recently as the 2008 crisis. So you can see that our credit rating, our sovereign credit rating is well above investment grade. GDP per capita, at least prior to this COVID crisis, significantly higher despite a larger population. Our debt to GDP significantly lower than it was in 2009, and therefore giving government some fiscal space to come in and react to this crisis. And very importantly, our gross international reserves are actually increasing in this period. We're now at 87 billion US dollars in international reserves. And as I'll point out later, the exchange rate has remained stable throughout this crisis. Now, before I move ahead, I'd like to point out that you could think that not only is the government much more resilient in this crisis, but our banks as well are better capitalized than they were. They don't have a huge overhang of non-performing loans or bad assets. Our households prior to this crisis, unemployment was at an all-time low, and NEDA and the Statistics Authority was reporting that more and more of our countrymen were moving out of poverty. So I think it's not just the government sector that is more resilient this time around. Overall, I think all four quadrants or all four sectors of our economy are much stronger than they were in either 97 or 2009. But let's look at government, because I think whenever people start talking about recovery, they start thinking about stimulus and what government can do in order to speed the recovery as we move out of extreme quarantine into general quarantine, and then hopefully even more normalization. So first thing to note, because government has such fiscal space and a much better fiscal position, one of the things that it has done from the very beginning is to try to preserve the infrastructure program under Build, Build, Build. So Build, Build, Build remains intact. We can't actually build at the moment because of the quarantine, but very soon, and in areas that have already moved towards general quarantine, infrastructure spending by government is expected to infrastructure and construction is expected to restart, and spending on infrastructure by government is expected to continue. And so we are able to preserve the original goal of the administration, which was to lead development through infrastructure. Now, going beyond that, we've already implemented through the Bayanihan Law social amelioration projects. Toti mentioned that the initial response was truly a public-private partnership or Bayanihan, where wherein many of the large corporates or even smaller companies took a role in cushioning the impact of the pandemic, as well as the quarantine on their workers. But we were also able to quickly put out the Bayanihan Law, which is a target for roughly 370 billion in social amelioration and support to households. So those things are already in place. You have the Bayanihan Law and you have the Build program. What is under discussion now in Congress under what is now called the PESA bill, the consolidated bill, the consolidation of the proposal of both Congressman Salceda and Congresswoman Kimbo, is a range of stimulus measures that are intended to add on to the existing measures and push for recovery. But most of these measures, as I think Mike mentioned earlier, are targeted again to households, low income, work from home laborers, day laborers, no work, no pay, as well as actions by the central bank to strengthen and shore up the financial system. So in addition to the existing Build program, the PESA bill calls for an additional 650 billion in enhanced Build over 3 years. At the same time, they're proposing something like 111 billion pesos worth of wage subsidies in order to support MSMEs, workers in the MSME and the informal sectors. At the same time, and Mike has already mentioned this, the PSP has already deployed a range of measures, including regulatory relief, monetary easing, lowering of the lending window interest rate, and the reserve requirement cuts in order to provide support to the banking and financial sector. There is also a proposal under both the PESA bill and a separate bill filed by Congressman Kua for the revival of the SPV law, so that we could have a mechanism in place already for banks to securitize potential loan assets that they want to move off their books. So all of these are things that are being proposed to support or provide additional support for households and the banking and financial sectors. When it comes to the corporates, and I think that's why we're here this afternoon, there are also moves under the stimulus bill, under the PESA bill, for support to corporates. But you'll find that much of the concern or much of the programs are still targeted towards SMEs. And the thinking really there is that the sector of our population that is most at risk are the employees and workers in the SME sector or the informal sector. So you have programs like training and capacity building for SMEs, and bridge loans to SMEs in order to get them over this period of non-activity while we are all under quarantine. And then you're looking at things like agri-fishery loans, assistance to the tourism industry, assistance to exporters, roughly running into the 90-100 billion range. The two or three main large-scale support to larger corporates, but also available to SMEs, are these credit mediation restructuring guarantees, or guarantees to be provided, partial guarantees to be provided by Phil Guarantee for loans and borrowings by primarily, again, SMEs, as well as interest-free loans in order to protect jobs, to be to be made out by Land Bank and DBP, but limited to 50% of the cost of the payroll for firms. And the most interesting portion, I think, for corporates would be Congressman Salcedo's proposal for the creation of a National Emergency Investment Corporation, or NEIC, which would provide direct support for companies that are distressed, either by taking an equity position in these companies or providing some kind of loan or purchasing securities by these companies. But you'll notice that the allocation for that is roughly 300 billion. So the total package, more or less, for the corporate sector, which still, a portion of which will still go towards SMEs, is something like 696 billion being proposed under the PESA bill. Okay. Now, there would probably be some questions as to the ability of the existing GFIs to actually roll out that money in support of both SMEs and corporates. But particularly with respect to the creation of the National Emergency Investment Corp, there may be some concerns about the time it will take, since this would be a new GFI, the time it would take to get this thing started and staffed, and how long it would take actually before it could perform its designated function of providing asset support to corporates. In any case, 696 billion isn't that much, in my view, won't be enough support to the corporate sector. So ultimately, and this was something that Toti touched on as well, corporates, particularly large corporates and conglomerates, which are affected by the pandemic and the quarantine measures, will have to call on banks and the capital markets for support. And this is really, I think, where I think we should consider strongly, and Toti hinted at this already, we should consider strongly providing support to these larger corporates and conglomerates through the capital markets rather than the banking system. Even though the banking system is already receiving support from the BSP through monetary policy easing, through regulatory reliefs, through reserve requirements, and even though the BSP has substantial space to continue monetary easing, there is a natural pressure on the banks to be careful on how they lend during a crisis situation. They still have to contend with the credit risk of their potential borrowers, and that credit risk is amplified by the uncertainty of this new, the so-called new normal under the situation in the pandemic, wherein you cannot count on our past experience of consumer spending and consumer activity to predict how businesses will fare. So banks will naturally face challenges in making a credit decision under this new normal. And I would argue that this kind of higher risk is probably better suited to the capital markets. Now, Mike referred a while ago to the challenges that the mutual funds face with the potential for withdrawals from the funds. That risk is even greater when you're thinking about demand deposits and savings deposits with the banks. And that's why ideally this is a situation where longer term capital, Mike was referring to pension funds, but perhaps other sources of longer term capital which can hold on to their investment for, let's say, 3 to 5 years, and take on the larger risks brought about by the uncertainty of the new normal. It's with that kind of support, it would probably be more appropriate for the capital markets to allocate that kind of risk capital. And then the question then becomes, is it viable at this time to tap the capital markets? Luckily, Toti has graciously already announced that Ali will act as a kind of test case for the viability of tapping the capital markets in this period, because they are already planning a bond issuance off their shelf within the second quarter. But if you look at the broader situation for the environment at which we have today for tapping the markets, particularly the debt markets, it's not so bad. As Mike has already pointed out, and my colors are a little different from his colors, but the graph is essentially the same. The benchmark yield curve for government securities has come down significantly from the time when the quarantine first began. And again, this is largely due to strong and quick action by the Banco Central, and it's holding. So this lower rate regime, at least for the risk-free reference rate, is holding steadily at the moment. At the same time, we can observe that throughout this year, more or less, the exchange rate has remained very stable at roughly between 50.5 to the dollar to 51 to the dollar, but mainly in the 50.5 range. At the same time, the outlook for inflation remains low. We expect inflation to stay low, giving the BSP even more room in order to conduct their monetary policy easing. So at least when it comes to the reference curve and the pricing curve, it looks like a low interest regime. And the question then becomes, what is the what do you call this? What will be the premium charge for an actual issuance? At the same time, it seems that funds are available. Total bank deposits at the end of last year were something in the 14 trillion range, and we have something like 8 trillion within our institutional investor base. If a portion of that could be channeled towards support towards the corporate sector, potentially this private sector financial support to the corporate sector would be larger than what is being proposed under the stimulus bills. And in fact, we've had some earlier indication about the ability to tap the market. Within the quarantine period, well, actually in the case of BPI, slightly before the quarantine period, they were able to go to the market and raise funds. But perhaps the more interesting situation is the case of RCBC, wherein well into the quarantine period, they had a successful bond issuance in April, and at a rate that was not prohibitive given the situation at that time. I'll provide my slides later for you to see, and you can look at the two transactions by BPI and RCBC early during the quarantine period for yourselves. So there was some discussion earlier about what kind of recovery, and I think the important thing to remember here is that in both cases, both during the 97-98 financial crisis and the subprime crisis, we made it through. whether it's a U-shaped multi-year recovery, like in the case of the Asian financial crisis, or the quick recovery during the subprime crisis in 2008, we recovered. The big question now is what kind of recovery we will have under this crisis. And I would suggest that if we are able to deploy the existing resources that we have in the private sector and the savings that we currently have through the capital markets in order to support those corporates that have adjusted to the new normal and have new and responsive business plans to cope with 1, 2, or 3-year period under which we will have to live with COVID-19, then I think we would have a faster recovery rather than a slower one. And I'd like to end there. Thank you very much again for this opportunity, and happy to take your questions.
Okay, thank you very much, ComF. We have so many questions for so little time. So let's get right down to it. ComF, let me start with you. Just very quickly, what is emerging from this crisis is a strong shift to contactless interaction and digitization. And I'm curious to know whether the SEC is fully prepared for this, and if not, when do you expect the SEC to be ready for this?
I don't know if we are fully prepared, but we are responding. So maybe to a lesser extent than Ayala Land, we were already moving towards online transactions, and we had to ramp up our move to online because of this crisis. So right now, there are skeletal staff working in the offices at the PICC, but the majority is actually working from home, and we are processing. We're working every day, and our company registration department is in fact approving incorporations regularly, and as Toti has mentioned, we are processing issuances and registration statements.
So is there a lag in your ability to process given the limitations currently versus when you were on full force and working from the office?
I would say no. I think we've adapted to this work from home arrangement. So right now, for example, if you have a registration statement and you need to make a presentation to MSRD, we can accommodate the presentation through Zoom. And
okay.
And in fact, they've been in contact with the two exchanges, PSE and PDS, regularly since the quarantine started.
Okay. Very quickly, ComF, what sort of relief have you given to reporting companies, and what kind of relief or flexibilities are you intending to provide for the registration of securities, such as, for example, the effectivity of the FS, these things that tend to lengthen the process?
Right. So initially, what we've done is we've extended the deadlines for all of the reporting requirements, and we're taking a very lenient attitude, virtually a moratorium on the imposition of penalties, because we understand the difficulties. We had anticipated even before the quarantine there would be difficulties in the audits and in preparations for the AFS. Now, when it comes to going forward, we are in contact now through our Office of the General Accountant with the standard setting bodies on accounting rules. And we are looking at possibly relaxing portions of Rule 68 in order to make the lack or the difficulty in coming up with audited statements, removing that as a barrier to issuance. But we don't see it, but we're looking at it.
So it's a work in progress. We will expect some leeway that will be given to issuers on the issue of registration. Okay, let me shift. Sorry.
We understand the problem and we're working towards it.
Okay, thank you. Toti will be very pleased to hear that. Let me ask Toti. Toti, can I focus on your company's ecosystem, your supply chain, and I would imagine here that you would be dealing with suppliers that could very well fall under your SMEs, and then on the other side, your customers might have been impacted by this whole crisis scenario. And so there are probably a lot of weak links that could impact on your ability to operate and manage your cash flows, your financials. So what kind of support are you providing those weak links to strengthen them?
Yeah, we do have very strong relationships with our suppliers and vendors. As a matter of fact, our preferred mode of engagement is through a partnership. Long-term partnerships is what we appreciate. So during this period, we'd like to think that at some point we will be able to restart, and therefore we can continue working. But this early, we've already been exploring some supplier financing type of arrangements with the help of some of our partner banks. So in the case of our merchants in our malls, some of them will have difficulty because there's been no business.
Yes.
So we've referred them, or we have some sort of program with one of our banks to extend some sort of merchant financing. So a similar program is in place for our suppliers and vendors. They can opt to discount their receivables with our banks to generate liquidity. But I think more than that, it's really about making sure we have a mutually beneficial relationship over the long term. And so what that means is we look at our pipeline, and we ensure that there's sufficient projects that we allocate to them, rather than each and every project or each and every subsidiary having its own new suppliers per project. What we like to do is, let's look at the big picture across all our SBUs. What are the requirements? And then let's call in what we would call partners. So we accredit them, we nurture them, and I think the most important thing is we're here for the long term. It's not a transaction.
So the financial sustainability extends to ensuring that they're financially sustainable as well.
Yes, we do look at their balance sheet, and we calculate.
Yes.
We have some metrics that we calculate to make sure that they're strong, and hopefully we can cooperate during this difficult time. So it becomes a mutually beneficial engagement, because once we restart, and we will restart,
yes,
we are going to rely on these vendors, these suppliers, these partners of ours.
And they have to be ready to step up at that point. Yes. Let me shift to Mike. Mike, there's a business adage that says one should not let a good crisis go to waste. And I would imagine in your case, there must be certain opportunities in this crisis that you're looking at as a fund manager.
Yeah, I mean, definitely. I didn't want to say that earlier because it might sound insensitive, but certainly one should not waste this crisis. The opportunities are obvious in terms of on the valuation side. I think the prices have come off significantly in the equities market and other markets as well. And while we debate on the shape of the recovery, to me, what's important is the strength of the recovery, really. And without a doubt in my mind, the Philippines will come out of this very strongly. The corporates will take some time to adjust, but I think, as Toti very well explained, if every single company out there is undertaking similar programs that Ayala is taking, Ayala Land, it gives us a lot of confidence that these companies will come out very strongly. Investors will come back, particularly the foreign side. If you look at what has happened, there's been outflow year to date, probably of about $1 billion in the equity markets. But interestingly, the last couple of days, or at least yesterday, I think we saw some positive flows in the market as well. The issue has been more in the past valuations, but here we are, and the valuations do present themselves today. Of course, as fund managers, we need to manage risk. We shift from one asset class. Today, it's government bonds, which have provided the great returns. Tomorrow, we'll start looking a little bit more on the corporate credit side as we build up our equity positions as well. There are also opportunities offshore, let's not forget, because some of the companies that will really benefit and thrive from this, like IT companies, technology companies, unfortunately, there aren't a lot here. But there are those outside that we can also invest in today's world, through different funds. So definitely, this is a great time. One needs to approach it with caution, obviously, and with a strategy that suits your own objectives and risk appetite.
Is this market at this point only for the bold and the brave, or should
Well,
conservative investors consider this a
you,
good opportunity to start getting in?
I think this is a market. I mean, if you considered yourself a pure fixed income investor, which is conservative, you would be doing very well today. So to me, this is a market for all types of investors. You just need to match the strategy and the portfolio with your objectives and your tolerance for risk. I mean, if you're
Yeah.
an 80-year-old retiree, I don't think you should be putting all your money in the stock market today, unless
Or
you
going to
can afford to lose
25-year
all of that.
paper.
Well, but still, I think definitely that this is, again, maybe not once in a lifetime, but once every 10 years we have these opportunities, and we do need to look at them and seriously.
Let's not borrow our heads under the sand, but take a look at what's available and interesting. We're supposed to have ended about 5 minutes ago, but I think we can extend for another 5 or so minutes so that we can ask a few of that long list of questions that we have been receiving. One question that has seems to be in the minds of so many of our attendees is the corporate bond market. There's an observation that it seems that it's not robust, and it has not been robust enough. And so they're asking what it will take for the corporate bond market to flourish. I guess they're referring now to the secondary market trading, which is far off from I guess the strength and the volume in the government securities market. Can I throw that question both to Toti and Mike?
Thank you, Malu. And I'll answer this from the perspective of an issuer. I think clearly we need more issuers to come to the market with more innovative instruments. In our case, we want to go back with our home starter bond. If you recall, that was catering to the small retail investors. What we want to do is bring it back to the original format where you don't need a big sum. You can invest on a monthly basis, small amounts leading to say 300,000 after 3 years, which you can then use as a down payment for property. So we need instruments that will tap the not just the high net worth individuals, not just the institutions, but even the retail, the small retail client. Mm-hmm. And the other thing we tried to push for, and I guess Matong was not there yet, was we wanted to graduate some of our unlisted subsidiaries into the capital markets. So we felt that we have some very strong subsidiaries, but they're not publicly listed. And what we thought that time was they should be good. They have good enough track records. They have strong enough balance sheets to access the debt capital markets. But the requirements for these smaller businesses, and I think this would apply to MSMEs, can be a little bit stringent. And in particular, for example, the requirement to have independent directors. Because it's the thinking is, if you're issuing a publicly issued instrument, you got to be like a publicly listed company. Hence the need for independent directors. I think that's a little difficult for the smaller businesses to comply. But I would like to see not just big companies going to the capital markets, but even the MSMEs. Yes. I think the market is smart enough to differentiate and to distinguish the credit qualities. We have the ratings agencies, we've got the underwriters, and of course the regulators are there to really pour through the documents that are submitted and for them to say, are you fit to go to the public markets? So more I would say more issuers is clear, and not just the usual suspects.
I will go to ComF later on that, but first let me get the thoughts very quickly of Mike on why the corporate bond market is very lackadaisical in the trading.
Yeah, so one, I agree with Toti, that's the supply side, and I don't think we'll see any shortage of issuers in this environment. No? And I think the strategy of issuing a short-term bond at this point makes absolute sense. I have no doubt in my mind that Ali will be able to raise the 10 billion or so that it needs. Uh, but I think in the medium term, and also to prevent this crisis, one really needs to match the supply with the demand, no? And for the longer term, we know it's pensions and all that that will
Yeah.
create the demand and allow bonds to be bought and traded. But in the short term, creating vehicles and specialized funds to buy these bonds, I think is necessary to make sure that corporates are able to refinance and continue borrowing from raising money from the capital markets. I guess there could be some tweaks on how bonds are traded, perpetual withholding tax issues and all of that stuff. But I mean, those are things that need to be addressed in the longer term. But I think it's really creating the pool of demand and the right vehicle and structure to be able to match the supply that we will see coming out in the next few months.
Thank you. ComF, just very quickly, there's a question on, and I think Toti kind of raises on the SMEs. How do we encourage SMEs to list? What can be done to pull them in and give them access to equity financing?
Yeah, thanks for that, Manu. That's probably a whole separate webinar that I would volunteer to be on with Toti and his subsidiaries. But to respond to Toti's concern, I don't supervise corporate governance at the moment. It's actually my colleague, Commissioner Calvin Lee. But you'll notice that corporate governance requirements are now comply or explain. So there are mechanisms already, and you could probably discuss with them, mechanisms to accommodate issues faced by the SMEs. But I think it's a much broader discussion for another time.
Okay, we've gone way beyond the time allotted for this webinar. Before I call in Zondi for the closing remarks, just final words from the three of you. I guess for Toti and Mike, your asks, because the regulator is here, and from the regulator, your thoughts on how to get the capital markets going in this time and post-COVID. Let's start with Mike, then Toti, and then ComF.
Yeah, just quickly, I think we talk a lot to the SEC and ComF, so he knows our whole wish list. But I think in this environment, my whole point earlier is speed. No? We need to move fast to be able to address any crisis that is about to erupt, particularly in the credit market. So at this stage, I think it's creating those vehicles and those funds that can effectively mobilize the 8 trillion or so of institutional money into the corporate market.
Speed is of the essence. Toti?
There's not much I can ask for ComF because every time we see each other, he grants it and he
Wow.
acts right away. But I guess I just wanted to reiterate, let's see how we can get the SMEs into the corporate bond market. I think that would really be the next step in the maturity of our debt capital markets.
Let's get the intermediaries into the loop on that. ComF?
Yeah, so to take off from Tony's statement on the SMEs, I think this is there was a question a while ago about why is the corporate bond market bigger than it could be, and I think for the longest time, because the simple answer was it's easier to go to your bank and get a loan than learn how to tap the corporate market. But this situation might be a little different, as Mike was saying. This kind of crisis, it might actually be cheaper for you to process something through the capital markets and wait in line to get a good price on your loan from the bank. So I think there's an opportunity. The other thing I want to say is, I think there is a mistaken belief that our corporate bond market should only be a AAA, AA market. I don't think it needs to be that way. So I agree completely with Toti that SMEs, which by definition won't have the same credit rating as that of an Ayala land, should be able to tap the market. The Philippines was able to tap the international bond market even before we were triple B plus. We were double B minus, and we were still tapping the market. The market can accommodate a wide range of risk and credit levels. But I think that the challenge is not enough people have tried.
Okay, thank you very much. Let me now call on Zondi Garcia for the wrap up and the closing remarks. Thank you very much, gentlemen, for the very interesting presentations and discussion. Zondi? Zondi?
Good afternoon, everyone. Thank you for everyone to join this seminar. And the only thing I can say is I think not a single one of us here, even those who registered, really expected that in a span of 25 years, you will encounter 3 major financial crises. You know, the Asian crisis, subprime, and this one. And the last 2 being black swan events at that time. And the question really is like, are we more prepared or are more resilient this time? And Warren Buffett said that, you know, when the river runs dry, it is when you see who is swimming naked. And I think what is good about our panelists is that they showed us that not a single one of the different stakeholders are really swimming naked. You know, ComF highlighted the fact that, look, we are a much stronger Philippines, right? 5 notches above the rating from the last crisis, double the reserves, with a lot of headroom for debt financing to finance stimulus packages. Toti talked about, you know, the typical Ayala way of how to survive, stabilize, and thrive in this crisis. I think Toti was also trying to prove that he was deserving of the ING FINEX CFO of the Year. And he wanted to win again this year. But Toti, I'm sorry to tell you that you can only win once. You know, the only thing that was really so sad about what Toti mentioned was that there is no fire sale in the Ayala properties. And I thought we were expecting that would be like the silver lining, yeah, in this crisis. Now, in the case of Mike, he emphasized that, you know, the triple Vs, yeah, that, you know, the market may be gripped with fear because of the virus, there is volatility, but there is value. And you don't really have to be that brave to make money. Of course, you just have to put your money with the professional fund managers and you can make good money. But one thing that is also interesting is that not only are these people being tactical at this time, but they're actually already preparing for the long term. So which means that everyone knows that we will get over this sooner than later. And so Mike talked about the pension fund reform, which is really quite structural. And talking about long-term plans, I think I'm happy to say that the FINEX, you know, led by the former president, Attorney Dick Baladad, has worked closely with BTR, SEC, BSP to craft a 5-year blueprint that was actually submitted to the DOF. And that 5-year blueprint will really set the roadmap, no, for a much more robust capital market that will be a lot more inclusive. And I'm happy to say that what Mike mentioned as a pension fund reform is actually part of the reforms that are there, including actually also addressing the needs of the MSMEs. So in summary, I'd like to say that, you know, as everybody said, we should not waste a crisis. We should not, you know, it shows that, you know, how strong we are inside. And it also gives us an opportunity to really work on the structural reforms that will be good for all of us. So in the end, in summary, let me thank all our panelists. You really are, you know, gave a lot more than the topic on the capital markets. I think it really provided a lot more insight to those who registered. And I'd like to thank my partners in crime, Malu and Tess, and of course, the very hardworking FINEX team for making this webinar a success. And of course, for those who registered and stayed on to the very last, thank you. And you know, we are going to think about doing a part 2 and looking at the other stakeholders on the capital market. So thank you once again and good afternoon.
Just one final word. There are 32 questions that were not asked. So what we hope we can do is forward these to the panelists, get the responses, and find a way of being able to circulate the responses. Thank you very much. Good afternoon, ladies and gentlemen.
Okay, bye-bye. Thanks again.
Thank you.
Bye.
Bye.
Thank you.
Thank you, everyone.